Very good morning to all of you. So we had covered about clubbing and set off and carry forward loss in the earlier session. So probably what we'll do is we'll just take a brief overview or just re-understand whatever we have taken through in the earlier class so that you get a better understanding on the chapter as a whole. So when we spoke about clubbing, we said clubbing is about an intentional transfer to avoid. It's an intentional transfer to avoid tax. So basically we said about a typical family. So this is an intentional transfer. The transfer could be income or an asset, and the income thereon could also be transferred. So that's the typical situation. So either the income is transferred without transferring of asset, or asset is transferred. When income is transferred, we said the income in both these cases, it will be clubbed in the hands of the transferor, right? We saw various scenarios for that. So first is income alone is transferred. And then we said asset is transferred. We spoke about revocable transfer. And then we also discussed about spouse income. So spouse income. So spouse income. And then we spoke about the daughter-in-law, right? Daughter-in-law's income. Then fifth one, we spoke about minor income. Last one we discussed about cross transfers. So these are the 6 scenarios that we discussed yesterday. So we spoke about the first concept where income alone is taxable. When you say income alone is transferred, the income, whatever. We spoke about an example where rent, property belongs. For this we discussed, property belongs to A, rent is received by Mrs. A. So now what happens? The rent has been clubbed in hands of Mr. A. So this is first thing. And then we spoke about the second concept of revocable transfer, where we said when it comes to revocable transfer, it is some form of right or power might come back to the transfer itself. So there is some form of right or power might come back to the transfer itself, reassuming power, retransfer of rights. So if there is something of that kind provided in the clause, it becomes revocable. Otherwise, if it is for the lifetime, so when you say revocable, what is irrevocable? Irrevocable is basically, we are trying to talk about for the lifetime of the beneficiary or the transferee. There is no coming back. There is no right coming back. There is no power coming back. In that case, it becomes irrevocable. So this is what we discussed in irrevocable transfer. So if it is an irrevocable transfer, it need not be clubbed. But in irrevocable transfer also, we saw a situation, some form of benefit. If you actually remember, we discussed about a situation where, let's say, an income is 10,000, 8,000 will go to the transferee. The agreement or arrangement says 2,000 will always come back to the transferor. In that case, the 8,000 also should be clubbed in the hands of transfer. We said the whole income will be taxed in the hands of transferor. So these are the things we discussed about revocable asset. Then we moved on to the spouse income. So we spoke about the spouse income. We spoke about 2 things. One is income, another is asset. In form of income, we spoke about remuneration. So we spoke about in spouse, we spoke about remuneration and then asset. What did we say for remuneration? We said if the other spouse, if the partner has substantial interest. If you remember, we spoke about a person called Rahul, his wife Pooja Rahul. Now this Rahul had substantial interest, that is more than 20% of equity share or profit share. If it's a company, it is equity share. If it is a profit, if it is a firm or any other organization, it's a profit share. So if a particular person, that is in our case, it was Rahul, he was owning substantial interest in particular company. So in that company, what did that company do? The company recruited Pooja Rahul as finance manager. So this person is receiving salary. It could be in the form of salary or commission or fee or whatever form on a monthly remuneration basis. This remuneration is provided to Pooja Rahul, but there is no proper educational qualification for her. For example, let's say she's not even a BCom graduate who can handle accounting or something, but she has been appointed as a finance manager. Now, in this situation, this income of Pooja Rahul will be clubbed in the hands of Mr. Rahul. But the provision, we said the provision will not be applicable if the concerned person, that is the spouse, has technical or professional qualification to be appointed in that particular position. So if we spoke in our example, what if Pooja Rahul was a chartered accountant? So in that case, what happens is automatically it will only be taxed in the hands of Pooja. It will not go back to Rahul. So that is what we discussed as far as your remuneration goes. In case of asset, we spoke about two situations. One is it's a house property. Another is it is something else. That is when you say other asset. So we'll keep it as other asset. So when it comes to house property, we said house property. As far as house property goes, if it is transferred for living apart, that is in case of diverse settlement, if the house property is provided, then we said if this is basically not club. Otherwise, anything other than that will be clubbed in the hands of transfer. The property shall be the assessee itself, that is the concerned person who was transferred itself will be considered to be the deemed owner of such house property. So this is what we discussed in house property. And for other asset, we said it has to be clubbed. Then we also spoke about the daughter-in-law. So similarly, exactly same as spouse. In case if father-in-law or mother-in-law is transferring some asset to this daughter-in-law, then that income shall be clubbed. Sorry. So then that income shall be clubbed in the hands of the father-in-law or the mother-in-law. So this is also we discussed. And then we discussed about minor income. Minor income, we said it shall be clubbed other than skill. So if it is based on skilled income, then it shall not be other than skill. So if some income other than the skill, then it shall be clubbed. If it is because of the skill set, then it need not be clubbed. But if that skilled income is deposited into an account, that interest or whatever you're talking still should be clubbed. We also spoke about, when I'm talking about this interest on such skill portion is still clubbed. Only this is not clubbed. Everything else is clubbed. Now, if you actually see, when we are speaking about this concept of interest, we also spoke about the concept of accretion. And we also spoke about investment. We spoke about these two concepts. What did we say for accretion? The primary income alone should be clubbed. The secondary, that is, if subsequently it has been invested in something, that income from that should not be clubbed. In our example, we are talking about rental income is received of an asset which has been transferred to the spouse. This rental income will be clubbed, correct? Now, but if this rental income is reinvested into a recurring deposit or a fixed deposit, interest from such deposit will not be clubbed because it is accretion. So it will not be clubbed. So this is what you're calling as this primary income alone will be clubbed. Secondary income in form of investment will not be clubbed. When we are talking about investment, we also discussed about what if directly gift as capital. That is, a particular partner, the father-in-law, mother-in-law, or the spouse is transferring an amount for the purpose of investing into a particular business. In that case, what did we say? We say proportionate capital. Proportionate capital, relevant profit. So the profit relating to that particular capital. Remember, we spoke about an issue called as Vaibhav Vaishali. Vaishali gave 5 lakhs to Vaibhav. Correct? Vaishali gave 5 lakhs to Vaibhav. Vaibhav has already invested 5 lakhs. So we remember, if you speak, Vaibhav has already invested 5 lakhs, but he has already made, in the previous year, he made a loss of 3 lakhs. So as on 1st April 21, he had a closing balance of 2 lakhs. He had a closing balance of 3 lakhs. So as on 1st April 2021, his capital stands at 3 lakhs. Now Vaishali gives him on 1st April 21, she gives him 5 lakhs. Now any profit that is accruing to Vaibhav will be split in the ratio of 3/8 and 5/8. Nothing but you taken a proportionate, right? So 3/8 and 5/8. So whatever profit should be apportioned between 3/8 and 5/8. So whatever proportion of 5/8 will be taxed in the hands of Vaishali and not Vaibhav. So that's the thing, right? So that is how the investment gets accumulated. That is, investment gets clubbed. So this is what overall we covered. The last one of minor income, we also spoke about 1,500 per kid per annum. Per kid per annum. Is there any limitation on the number of childs? No. Limitation of number of childs? No limit. No limit on child. Right? So there is no limit on child. So it is, for everyone, it is 1,500 per kid per annum. So that is eligible for minor, whatever we saw. When we say 1,500, what are we saying? It is actual or 1,500, whichever is lower. Right? Because the maximum exemption is 1,500. In case if your income itself is less than 1,500. In our illustration, what we saw yesterday, there was this minor kid which earned 1,200. So in that case, the exemption was only 1,200. We did not give 1,500, right? So these are all what we discussed in clubbing of income. We'll just try to see a small example what we discussed based on clubbing itself, and probably rework this exercise which we missed out yesterday, and just get a better understanding. So in this example, we are saying there is this person, minor Varsha. So minor Varsha is basically has earned the following income in this relevant year. She has received prize income from Indian Idol Junior. So she has received that of 2 lakhs. Interest of fixed deposit is 21,000. Interest from debenture is 12,000. Now comes the point. Father's income is 9.5 lakhs. After what? After including all the income of Varsha. Mother's income is 7,50,000. Now when both the parent are earning, which income do you club? We discussed this. What did we say? It should be clubbed in the parent's hand whose income is higher than the other, higher income, provided it is before including this minor income. So before including this minor income, we'll have to calculate each parent's income. Whichever is higher, it will be clubbed in that hands of income. So that is the provision. So now we will try to compute this. So we will try to understand the provision. So what are we saying? We'll have to compute the father income, because in father's income you have clubbed the Varsha's income also. So father income is 9,50,000. How much has Varsha totally earned? She was part of Indian Idol. So there she got how much? 2 lakhs, right? So she got 2 lakhs. Interest FD. How much is that? Interest FD, it is 21,000. And then you have interest of what? Debenture. Interest of debenture, how much was that? 12,000. So now 2,33,000. If you remove this, father income will be how much? 7,17,000. So this 7,17,000. So mother's income. Mother income is how much? 7,50,000. So mother income is 7,50,000. So that's what is this income. So whichever is what? Whichever is higher. So this is what it will be included, whichever is higher. So now in this concept, whatever we are doing is mother's income is the highest. So we need to club Varsha's income in mother's income. So that's what we are talking about. Now what are we going to do? We are going to just do the income. So mother's income is 7,50,000. Interest on FD, because the Indian Idol income is from skill. So that is not included. That 2 lakh is not included. The interest on FD, whatever we are talking, what did we say? If it is a minor's income, even that skilled income is reinvested and some interest is accrued out of it, that interest is still clubbed. So this is what we need to understand. So what is the interest on FD? It is 21 and debenture is 12,000. So put together it will be 7,83,000 will be mother's income. So that's what the provision talks about. So this is how it will be taxed. So 7,83,000 will be the mother's income. 7,17,000 will be the 7,17,000 will be the father's income. So this is about the clubbing of income. Then we discussed about income, setting off and carrying forward of losses, right? So we discussed about it. We will first understand two things. The order. We spoke about interest source. We spoke about inter-source. So when we said inter-source, that is the first option. Then inter-head, this is the second option. And then we said carry forward. So that is the third thing. So any loss available. So in fact, Parsha had actually questioned that what happens about there is a question number 8 in your book material where it says the discontinued business loss. The discontinued business loss, it's adjusted with the business income. So the question was, since there are already available carry forward losses, there are excess carry forward losses. So what happens when there is excess carry forward losses? What happens? Can I say first I will adjust this carry forward and then come to current year losses? No. So the first is this, second with the head. So when you have a discontinued loss of current year, you should first adjust with your business income itself. Only then you can go into inter-head. So you can't adjust, since you have excess loss, you cannot adjust the carry forward first and then use that losses with the rest of the income. So we cannot do that. So that is what it is about. So with this, we also discussed about the order. So we said if it is a house property, it can be, the losses can be adjusted with all other heads, right from salary to income from other sources. Your house property loss can be adjusted with everything. Whereas your PGBP, that is your speculative, when it comes to speculative, it can only be adjusted with speculative. When it comes to 35 AD, it can only be adjusted with the 35 AD. If it's a regular business, it can be adjusted with all business losses. That is speculative. 35AD. 35AD is nothing but specified business. And then the regular loss. What about short-term capital loss? Short-term capital loss can be adjusted with both short-term and long-term. But what about long-term? Long-term can be adjusted only with the long-term itself. It cannot be adjusted with anything else. For horse race, it can only be adjusted with the horse race. For income from other sources, it can be adjusted with so many other heads also. Now, we saw various questions for this. We'll try to just come out with solving one of them before we move on to deductions. So let's take this. You have income from house property that is computed, and then you have income from business before providing depreciation. So that is 1,35,000. Then you have short-term capital gain on sale, that is 56,000, and then you have long-term capital loss, which is brought forward, that is 90,000. Income from tea business is 1,20,000. Dividends from Indian companies is 80,000. Current year depreciation is 26,000. And brought forward business loss 6 years ago is 45,000. So these are the incomes provided. So we'll have to start with income from house property. So you have house property income. How much is the income? It is 1,25,000. Okay, and you have business. In business, you have multiple business. First thing, they're talking about a regular business, which is 1,35,000, and you have a depreciation of 26,000 in that. So 1,35,000, depreciation of 26,000. So your income will be what? 1,09,000. So that is your income here. So 1,09,000 becomes your income from business. And then you have short-term and long-term losses, but you also have tea business. So we'll have to compute business first. So tea business. In tea business, the provision says only 40% will be treated as business income. So only 40%. As far as the provisions of tea business in agriculture, 40% only is treated as this business. That is your. So this 1,20,000, only 48,000. So only 48,000 will be considered as your income. So total you have 1,57,000. Now you have dividends of 80,000. Current year depreciation, brought forward business loss incurred 6 years ago. So that can be adjusted with business. Brought forward loss of 45,000. So it is 1,02,000. So this is your business income. And then you have capital gain. What is capital gain? Short-term capital gain is 56. Long-term capital loss is 90,000. So short-term capital gain can be, long-term capital loss cannot be adjusted with short-term capital gain. So that is not allowed. So whatever the short-term capital gain is straight away taxable. STCG at 56,000. So this is also straight away taxable. And then you have dividend from companies carrying on agriculture operations. Dividend is currently entirely taxable. So dividend of 80,000 is straight away taxable. So now the long-term capital loss will be carried forward. Long-term capital loss will be carried forward to the next year. Whatever amount it was, 90,000 if I'm right, 90,000 will be carried forward because long-term capital loss cannot be adjusted with that particular thing. So that is what this provision is all about, correct? So this is how you actually adjust. So there is always this order, first inter-source, then inter-head, and only then you will have to come back to carry forward losses. So in this order, we'll have to adjust. We cannot overtake this order. So that's the day. And same way in business, we said when it comes to business, first year current year depreciation, current year scientific research, current year family planning expenditure, then only then you'll have to go to brought forward losses, brought forward depreciation, brought forward scientific research, brought forward family planning. That is whatever has been carried forward. So that is how the provision works. So that's all probably what we discussed yesterday. So I'll just answer some of the questions. Yeah, what if we are gifting debentures? The debentures income will be clubbed, and the sale of debenture, generally what happens is the asset, whatever is clubbed, the income from that asset will be clubbed. When it's basically it is being transferred, that is the sale consideration, sale of the debenture will not be clubbed. Whatever is being clubbed is only the income portion. So that alone will be clubbed without adequate consideration. Yeah, the interest of minor is actually not considered as accretion. So whatever is the interest income will be taxable only in the hands of the clubbing person. The house property without adequate consideration to the daughter, if it's a minor daughter, then yeah, it will be clubbed. Kanish wants to know whether the 7,17,000 will be clubbed in the spouse income. We do not know how each spouse is earning the income. It is assumed that they both are earning in their independent capacity. So we are not clubbing the spouse income. We are only clubbing the minor's income because we do not know the answer whether the other income, the spouse income of 7,17,000, whether was through skill, that is, was whether on his own way or about that substantial interest. Nothing of that is discussed in the question. So we'll not go into that. In case if it's a skilled income, it is taxable in the minor's hand only. Minor needs to obtain PAN on that case. So Ashish, minor must obtain PAN in case they have skilled income because it has to be reported under their name. And for set off and carry forward, as I told you, it's that table. Probably you can go through the table. The only thing is we'll have to understand that one particular table, whatever we are discussing, house property, it can be adjusted with any age, subject to maximum of 2 lakhs. Speculative, only with speculative. Specified business, only with specified business. Regular business losses, you can adjust with speculative, specified, regular. So inter-source business income, regular business loss is inter-source. And then you have short-term capital loss, both with short-term and long-term. Long-term capital loss only with long-term. Horse race only with horse race. So you can go back to this table. That alone is included. And probably there are so many questions about minor incomes interest being clubbed. That is a provision. Probably we'll leave it as it is. If it is a skilled income of minor, it must not be clubbed. If it is any interest income, even though it is from that skilled income, it doesn't matter, it has to be clubbed. So that's the provision as it is. If you probably ask me why, if that skilled income has not been deposited, probably father would have arranged money. So it's typically any additional interest or any additional income which is not by skill. We'll keep it this way, whether that income is skill or not skill. That is the one thing. If skilled income is reinvested, then it is not skilled. So that's the point. So if it is skilled or not skilled is what we need to consider. Investing in FD is not skilled, even if it is through a skilled income. So hope I have covered this. So we'll move on to today's whatever we need to cover today. So we are going to cover depreciations, so deductions today. So deductions are discussed in chapter 6A. So what is chapter 6A? Before getting into this chapter 6A, let's understand this common difference between exemption and deduction. So when you say exemption and deduction, typically what happens is exemption is discussed in chapter 3 of Income Tax Act. Chapter 3 of Income Tax Act, where you have section 10, which says these are the incomes that are exempt. What do you mean by exempt? It is not included. It is not included in total income. So it is not part of income at all. So that income is only called as your exempt income. So the exemption could be wholly or partly. Take HRA for example. What is the provision for HRA? Try to just refresh your salary portions. salary being the most important portion for your exam, probably you'll have to immediately tell what is HRA, what is exempt. What is exempt? Least of three, right? You have your what? 50% or 40% depending upon the city of your salary. Then you have rent paid minus 10% of salary. Then actual HRA, whichever is least is what is exempt. So the HRA exemption could be the entire HRA or could be lesser than that. So it could be 100% or less than 100%, wholly or partly. So depending upon the provision, it might change. For example, let's take share of profit. Profit from firm. It is 100% exempt in the hands of the partner, correct? It is fully exempt. So in that case, it is wholly exempt. So that is how exemption is decided. What about deduction? Deduction is provided in chapter 6A. So is the difference between 3 and 6A? No, that's not the number that we are talking about. What we are trying to say is it is included. It is included in gross total income and only then deducted. Here also, deduction could be wholly or partly. Before we get into the section, probably we'll try to see 80C or 80G. 80G will be about donations. So this donation, the entire donation is not exempt for all donation. There is a calculation methodology whereby probably you might get 50% of the donation or exemption. Only in few cases you will get the 100% of donation as exemption. So here also, similar to what we discussed in HRA or share of profit of firm, here also the whatever deduction you are claiming could either be 100% or could be a lesser percentage also. So depending upon the provision, it will vary. So that's what we are going to see in the today and tomorrow. What we are going to understand is what are the provisions that are applicable to intermediate, what are the provisions that are for which deductions are eligible, what is the proportion of deduction. So that's what we are going to see. It will either be wholly or partly. So that is your deduction. So the main difference, what would we say? Exemption is not included in total income. Deduction is included and then deducted. Right? The word deduction, it is reduced from the total income. So that's the main difference. Now, moving on, the first section of chapter 6A is 80A. The first section of chapter 6A is your 80A. So what is 80A talking about? It is called as charging section. So what do you mean by charging section? Let's probably go to a salary chapter itself. So again, let me repeat, it's the most important chapter for your intermediate. So what does the salary provision says? It starts with section 15. So what is section 15? Section 15 tells income will be chargeable as salaries. What is due, paid to, and arrears. So section 15 says whatever is due by the employer, whatever is paid to the employee, including arrear salary, is chargeable as salaries. So it creates the charge. It creates the power to tax. Power to tax. So charging section gives that power. Similarly, 80A gives the power to deduct. So 80A tells you that a particular income can be deducted. So that's what they are actually referring. So what does 80A says? 80A1 says deduction shall be allowed. So that's the power to deduct. Deduction shall be allowed from between sections 80C to 80U. It shall be deducted from gross total income. So on gross total income, you are claiming deduction. The next one is limit. What is about the limit that is being said? When you say limit, it's a common word. What is about the limit? You're trying to understand how much is eligible. Am I eligible for 100% or lesser than 100%? So that's what we are going to understand. When you say limit, I am using the word 100% or lesser. Can I come and say, you pay 100, you are eligible for deduction for 150. So my income itself is 100. Can I say I'm eligible for 150? I can't, right? That is what subsection 2 says. It says your deduction does not exceed gross total income. Does not exceed gross total income. So, what is the point here? Assessee cannot have a loss due to deductions. When you say 100 minus 150, 100 is income, 150 is deduction. What it becomes? Minus 50. Can I report a loss of minus 50 because of deduction? No. So that's the point. It says you cannot have a loss due to deduction. So that's the second point. What is the third point? That is third subsection. Third subsection is the restriction. Restriction says in certain case of assessee, that is association of person and BOA. In association of person and BOA, what the provision says is, it says the deduction claimed by AOP or BOA for certain things. I will not go into the specific of these sections right now. Of course, we'll discuss it in detail. I guess we all know what ATG is about because we only said in the previous slide. It is about donation. So these three sections, typically, if a deduction is claimed by the association of person or body of individual, it cannot be reclaimed. It cannot be again claimed as deduction by the respective member, the individual. So particular donation cannot be claimed by both AOP and member. Why? Very simple, right? Very simple, because it becomes double deduction. You cannot allow double deduction. So you'll have to restrict it to only one people. So when it comes to AOP or BOA, these three sections, it is only eligible with respect to that particular entity and not eligible to the member. So that's what is it. The next 4 to 6, just listen. Don't probably try to get into this. The reason is this is not applicable for your intermediate. Only the basic understanding is required for your intermediate. So just understand what I'm probably trying to tell you here. That is between subsection 4 to 6, which is actually called as profit-linked deduction. What is profit-linked? I have a business. We'll take this example. I have a business. Let's take ITC company. They have a unit in SEZ, that is Special Economic Zone. So when you have a unit in Special Economic Zone, you are eligible for deduction under section 10AA, or in some business, let's say specified businesses. You have section like 80IA, we can actually call it as infrastructure. So infrastructure business or certain specified businesses is eligible under 80IA. And they also have other businesses. Okay. Your usual 28, section 28 to 43. So section 28 to 43, where you see how much is eligible, how much is not eligible as deduction under business or profession. Now, this other business that we are talking about, these are the three categories. These two are eligible for deductions. Okay. 80IA says that whatever your profit, depending upon the number of years, for some years it is 100%, and then you have another percentage, depending upon the section and business. So your deduction is based on your profit. It is not based on the expenditure that you're making, it's on your profit. So if I have made profit of 100, I might be eligible for a deduction of 100%. That is 100. So I will be entirely claiming this 100. So this is called profit-linked deduction. So what the provision says is, if you are claiming profit and gains allowed as deduction under this section, for the same income, don't claim other chapter 6A deductions. So other chapter 6A deductions are ATC, 80G, donation or whatever. Now, since my entire 100 is now not taxed, can I also claim donation on same income? It is again what? Whatever we discussed as double deduction, right? So if I'm claiming a deduction under this profit link, my entire profit is exempt, deductible. Why should I claim another deduction on the same income? So that is what they say. If you are claiming chapters, this 10A or heading C, this heading C is what? Profit link deduction. So on that income, you again don't claim any other deductions. So that is the first thing. And the second thing is deduction cannot exceed. Similar to what we discussed here. So I'm not stressing again. So in this case, it is restricted to this profit alone. If your profit is 100, your deduction can only be 100. It cannot be more than 100. So that's the point. So you cannot make a loss just because of this deduction. And deduction must be claimed in the return. So while filing a return of income, you should mandatorily claim it, else you cannot claim it. Subsequently by during assessment or something. So during assessment or something, you cannot claim. So if you want this deduction, you'll have to claim it in your return of income. So that's the next thing. The last point in this is about transfer price. Transfer price. So what is transfer price? We'll again go back to our example. You have 3 units. SC is that infrastructure and other business. Now what about this other business? Other business is selling to SCZ unit. Let's say they are selling for 120. This 120 should typically be at market value. What is market value? Typically, what would be the price in an open market? Now, let's say you wanted to buy a mobile phone, Apple iPhone. You have a person who is very close to you. Let's say your uncle is running a business. Now, if you wanted to know the open market value, you should not check the price in your uncle's business. So, for this Apple phone, you have an uncle business, you have some third-party business. To know the market value, you should only check here. You cannot check with your uncle. Why? Because uncle will tell you a price just for your relationship. He may not tell you the actual price. So that's what this provision says. Whenever there is a transaction between these entities, it must be in market value. So that's what this provision says. On the date of transfer, whatever is the market value. So whatever profit-linked businesses, when they're transacting with other businesses, it must be in market value. So that is section 80A. Now we'll move on to the rest of the sections before getting into the deductions. The first thing is about computation that is discussed in section 80AB. So what does it say? When you have multiple business, 1 SEZ, 2 infrastructure, 3 business. When you have multiple business and you have this eligible business under 80IA or this heading C business, assume that this is your only business. So you must assume that this is your only business. That is how you must compute deduction. Compute as a separate books of account. Separate books of account. Infrastructure alone as a separate books of account. As if that is your only business, then compute deduction. So that is what 80AB says. 80AB says you will have to take only that particular portion. You should not take everything else. What does 80AC say? 80AC says to claim benefit under heading C. That heading C is your profit linked deductions. To claim this deduction, you must file your return of income. You must file your return of income on time. Within the due date specified under section 139(1). So that is the 80AC says. Coming to intermediate syllabus, what are the sections covered under heading C? These are the 3 sections, 80JJAA, which is relating to employee cost, royalty income under 80QQB, and your royalty on patent under 80RRB. These are the only 3 sections that are available for you for this particular section. So that is about it. Gross total income. So gross total income before, what is gross total income? Gross total income is before claiming any deduction. So typically what will be there? We'll just see how the computation works. We'll see how the computation works. You will have what? Salary, house property, PGBP, capital gain, IFOs, right? You will have some X amount. Now, this will be after set off and carry forward losses, right? So this will be after set off and adjusting your carry forward losses. Now on this, for all these things plus clubbing. So under each this said, whatever is clubbing, you club and then only you add. So this income after clubbing, after adjusting, is your gross total income. So that's what it said. So the formula says income under each head plus clubbing of income minus current year losses minus carry forward losses. So this only is called as your gross total income. So that is defined in 80B5. Now, how are we going to understand these provisions in our session? We are going to classify these deductions into various buckets. The first bucket calls payment basis. So it basically says when you pay for certain expenditures, that is allowed as a deduction. So on payment basis. Second one is depending on your income. That is your heading C. Heading C of chapter 6A, right? So heading C is for intermediate, what are the three provisions applicable? 80 JJA, 80 QQB and 80 RRB. So these are the three sections that we'll be covering in heading C. And next is deduction on other income. Deduction on other income. That is your IFOs, income from other sources. You have two sections, 80 TTA and 80 TTB. What does not fall under these three buckets is a miscellaneous bucket called others. It is only one section, that is 80U. So this is how we have classified the deduction chapter, and that is how we are going to understand in the rest of our chapters. This is how we will go proceed. So what are we going to first understand? It is about payment. So I'll just answer a few questions before going into this thing, before the ATC deductions. Yeah, so it is only about your whatever we are covering as these payment deductions, that is where we will cover each of this. So we'll discuss each section in detail. So probably when I discuss taking through the individual section about ATG and all, you will understand about donation a little detail. So for time being, we'll hold on to the questions because whatever is asked will be explained in the subsequent slides itself. Okay, the first section that we are going to understand is ATC. When we are saying ATC, we need to understand along with section 1010D. Moment I say section 10, what should come to your mind? Section 10 stands for exempt income. Section 10 stands for exempt income. So this section 10, subsection 10D will be covered in this particular slide. So as far as this slide goes, the life and endowment policy issued, is what we are going to cover. That is your life insurance policy, including endowment policy. For who all you can claim policy deductions? You can claim it for individual, you can claim it for spouse, for any child. When you say any child, it can be minor or major. So any child. So it includes any child. So any number of child, any category of child, minor or not minor also. So that is what it says. So only for these things. That is typically the family. The close family that our Indian tradition calls. That is your individual, spouse and any children. So it is eligible. Now we are classifying these ATC LIC premiums into three categories based on the date of issue. If the policy is issued before 1st April 2012, the maximum amount of premium paid should be less than 20% of ACSA. So ACSA is actual capital sum assured. We'll see the definition in the subsequent slide. So for time being, we'll understand it is actual capital sum assured. So if your actual capital sum assured is, let's say 1 lakh, your premium can be up to 20,000. So above that you cannot claim. You can only claim up to 20,000. So it should not exceed 20% of your actual capital sum assured. From April 2012 to March 2013, only for 1 year, only for one single year, what the provision says is, it is 10% of minimum capital sum assured. So now they are bringing in a capital called minimum sum assured. So this minimum sum assured is 10% less than. So in this case, they are bringing into 10%. That is your 10,000, right? From 1st April 2013, they are classifying a sub-classification based on if a person is covered under 80U or 80DDB. What is 80U? 80U is basically for disabled persons, disabled persons who are claiming self-deduction. 80DDB is dependent disease, specified disease. DD stands for dependent disease, which is specified disease. Not every disease, it's a specified disease. So for those two persons, the premium will be 15%. That is, if they are covered under that, then the premium is 15%. For everyone else, it is 10%. So these are the category. So currently from 1st April 2013, if a person is covered under 80U or 80DDB, then it is 15% of minimum sum assured. For everyone else, it is 10%. So this is what the provision is. Now, what exactly is actual capital sum assured? Actual capital sum assured is we need to ignore the value of bonus or otherwise. So whatever extra, when you're getting the premium, when you're getting a policy, new policy, they will tell you the policy is for 1 lakh, the policy is for 10 lakhs. This amount is their sum assured. This amount will generally not include bonus. Bonus is typically when you are paying promptly, when certain situations happen, you might get a bonus. So when you include that bonus, this 1 lakh premium policy could even be 1.5 lakhs or 2 lakhs. But what needs to be considered for our Chapter 6A 80C is only the actual capital sum assured. So this is what is provided. Now, recently we spoke about this concept of minimum sum assured from 1st April 2012. So what is minimum sum assured? Minimum sum assured is something arises when the sum assured is several numbers. Let's say for first 3 years, there is one number, let's say 1 lakh. Till 5th year, it becomes 1.5 lakhs. Till 10th year, it becomes 2 lakhs. If you have this kind of sum assured, you will have to take the minimum sum assured. Whatever is the minimum, that is what you need to consider. So that is what is given here. When there are varied actual sum assured, the actual capital sum assured is several numbers. It varies over the period. Then we'll have to take the minimum. So that is what happens here from 1st April 2012. And there is this policy that is also a policy covered under 80DD. 80DD is dependent disabled. You have a dependent who is disabled. Okay, you have taken an insurance on that. Thinking if something happens to the person who is insured, the amount will go to the disabled person. So this is the general what you call an understanding. But what sometimes happens is the person on whom you have actually covered the insurance passes away first. When he passes away first, then what happens is whatever amount you are getting will not be exempt under section 1010D. So to repeat this concept, there is A's brother, okay? A's brother B is disabled, okay? Now, A provides for B, he pays premium under 80DD, okay? Under 80DD. What happens is A keeps B as nominee to this policy. So if something happens to A, B will get the money from insurance policy and B will be able to survive their life based on that. So this is the typical scenario. But sometimes, let's take a case where this person dies, that is passes away first. That is pre-deceases. He passes away before A. So in this case, the premium goes back to A. Now this is not exempt. This is taxable. So that is what the provision is saying. So this 1010D is talking only about that. It is not exempt when it is actually coming back to the assessee itself. And any sum received under Keyman insurance policy. So what is Keyman insurance policy? Key persons of an organization, key managerial persons. KMP stands for key managerial persons. So Keyman insurance policy is for key managerial persons of a particular organization. Let's say a partner of a firm, a director of a company, a CFO of a company, CEO, all these key persons who are probably vital for the operations of the business. They are called as Keyman insurance policy. Whatever is received in form of Keyman insurance policy is not exempt under section 1010D. So in the previous slide, we spoke about deduction eligible for the premium paid. Now, for the last 10 minutes or so, we are talking about situation about receiving back the premium as sum assured or the bonus. When you receive back the money, if it is for 80DD3, it is not, it is taxable. If it is against Keyman insurance policy, it is taxable because it is not exempt under section 10 clause 10D. So that's why it is there. And there is another scenario where it becomes a deemed income. What is the word deemed? It is like it should be income. It should be income because the transaction is actually in the concept of income only. So you treat this as income. So that is called deemed income. If policy is terminated within 2 years. So if policy is terminated within 2 years, when it is a single premium. What is single premium? I pay premium only in the first year. For the whole tenure of my LIC policy, I will pay premium only in the first year. So that is called as 2 years. Before premium being paid for 2 years in other tenure. So within 2 years, I am terminating. So within 2 years, I am terminating in case of any other LIC policies. If it is a single premium LIC policy, 2 years before the policy passes away, I am terminating. So in this case, whatever deduction I have claimed will become my deemed income. Whatever deduction I have claimed will become my deemed income. So that is what the provision says. What are the additional conditions? There are some additional conditions in 1010D, which is newly introduced. So this is an amendment. So what does the amendment says? Any ULIP, unit linked insurance policy, which is linked to equity market. So this unit linked insurance policy, if issued after 1st February 2021, then in that case will not be available. That is, exemption will not be available if the premium payable exceed 2.5 lakhs. So in one particular year, if you are paying premium more than 2.5 lakhs in one particular year, then the exemption will not be available under section 1010D. So the government thinks you yourself are paying premium itself for 2.5 lakhs. Then why should I give you exemption? If you are capable of paying premium of 2.5 lakhs, which means you are earning so much of money, why should I give you that exemption? So deduction under section ULIPs is not available if your premium exceeds 2.5 lakhs. Now, what if I have multiple ULIPs? In that case, my aggregate premium. So what they're trying to say is, if you have a ULIP, let's say I have taken a ULIP on 1st March 21. Now, the premium I'm paying here is 2.6 lakhs per annum. So this is what? This is not allowed as deduction, correct? This is not allowed as deduction. As your the 1010D does not allow you deduction under this particular portion. Now let's say you have multiple things. So you have 3 premiums. For first you are paying 1 lakh. For second you are paying 75,000. For third you are paying 80,000. Now what is the total? 2,55,000. So here also they say it is not eligible because the aggregate is more than 2.5 lakhs. The new provision says if you have a unit linked insurance policy, if you have a unit linked insurance policy, in that case, any policies taken after 1st February 2021, newly taken. So existing policy does not come into this. Taken after 1st February 2021, if your premium or aggregate premium exceeds 2.5 lakhs, you are not eligible for deduction under section 80C, and no exemption is provided under section 1010D also. So that is what the exemption under section 1010D will not be available for that particular. So whatever ULIP you have invested, any income from that is not exempt. So that is with respect to 80C. So we'll see this example problem, which is basically 80C. They've given Ganesh has taken 3 policies. First is before 1st April 2012. Second and third is after 1st April 2012. So we saw 20% category. So we'll probably will compute here itself. So we'll have to see 20% of actual compute capital sum assured, which is 1 lakh. But the actual premium is only 51,000. So you can take as it is, correct? The second concept, it is from 1st May 2016. Here, it is 15%. It is 15% for people covered under 80U and 80DDB. Here it is covered under 80U. So here it is 15%. So what is the thing? It is 60,000. So whatever is eligible under 80,000 will only be 60,000. Okay. And here it is 10%. So what is 10%? It is 15,000. So what is eligible under 80C is 51,000 plus 15,000 plus 60,000. So equal to 66, 1,26,000. So what is eligible as 80C is 1,26,000 only, because the first policy, the policy is before 1st April 2012. So the maximum eligible premium is 20% of actual capital sum assured. So if the sum assured is 5 lakhs, 20% is 1 lakh, but my premium is only 51,000. So it is okay. The second concept, it is after 1st April 2013. After 1st April 2013, where it is for my spouse only. For the spouse, it is eligible. Maximum sum assured, minimum sum assured for that period. When there is no minimum sum assured, actual capital sum assured will be treated as minimum sum assured. So the sum assured is 1,50,000. On that, I am eligible for 10%. So my eligible 80C is only 15,000 and not 20,000. Same way with respect to a person covered under 80U. What is the maximum limit? 15% is eligible. So in this case, 4 lakhs into 15%, which is 60,000. So I'm only eligible for 60,000. So these three put together, I'm eligible for 1,26,000. So that's the thing. So the next category of that, what we are seeing is house payment. So I'll just see. Okay. Actual capital sum assured, probably Sushil have explained, it excludes bonus and other thing. Deemed income. What is deemed income? So when you say deemed income, whatever deduction you have paid, let's take, I've been paying, first year I have paid 30,000 premium. Second year also I have paid, let's say 25,000 premium. This 55,000, whatever premium you have paid will be your deemed income. So the entire deduction you have claimed for that policy is what is deemed income. So if your policy is terminated within 2 years, the entire deduction that you have claimed in those 2 years will be treated as your deemed income. So that is deemed income. Yeah, so that's the questions I have. So the maximum, yeah. So whatever percentage we discussed here, this only is eligible. The 20, 10 and 15 is only the limits that are eligible. So, okay. So I'll move on to the next section. That is your 80C with respect to repayment of housing loans. So in housing loan, you have two categories, right? You have two categories. One is interest. One is interest, which is discussed in your 24 clause B, right? The next is principal. So when you pay a loan, you pay principal and interest. These are not like your Amazon or Flipkart EMIs where there are no cost, right? So there are costs involved in your EMI. What is the cost involved? It is your interest. For that only you are eligible for deduction under section 24 clause B. But when you're paying this interest, you're also paying principal. Government says, I encourage you to buy a house. So if you're paying any principal as a loan, I will give you that also. The principal also I'll allow you as a deduction. So it's like my cost of house property is borne by the government. But is it available for everyone? Is it completely available? No, there are limits to it. So we'll see what all is applicable. So it says, whatever cost incurred on property chargeable under house property, including self-occupied. So it could be a self-occupied property or a let-out property. The cost, that is the principal amount. When you say principal, it is the cost of the property, right? You only pay back that. So that is allowed. You can also consider stamp duty, registration fee, and other expenses for the purpose of transfer. So to buy that property, if you have been paying any stamp duty, registration fees, or any other expense, that is also allowed. So is this eligible only for 1 year? No, for the entire tenure of your house property period. So that is for the whole period. So for the entire period of loan, this is eligible. So it's not 1 year alone, it is for the entire period. But certain expenditures are not allowed. They are admission fee, cost of share, or initial deposit. Typically, there are these cooperative housing societies. So once you become a member there, you'll be allotted a house or whatever. You can buy the house at lower rate. So what the government says is, if you're paying anything to become a member of such society or company, then that is not allowed. So whatever you're paying them to become a part of an organization which gives you benefit, housing benefit, that is not admissible. Then any addition, alteration, or renovation or repair. So anything, only purchase of house is allowed. Any loan acquired for renovation or repair or alteration or something, it is not allowed. I want to build one more room, one more floor, that is not allowed. So only for the fresh property, it is actually allowed. And any expenditure allowed under section 24, which is basically your interest. So they say you cannot claim your interest, you can only claim your principal here. So that is what is there. There is a condition attached to it. They say, see, I want you to buy a property. I want you to keep it for yourself for a very longer period. So government says, if you are transferring within 5 years from the end of financial year of purchase, let's say I have actually purchased on 10th June 2017. What is end of financial year? 31/3/2018. So that is end of financial year. So 5 years from this period. So what is the period? 19 is 1, 20, 21, 22, 23. So 31st March 23. If I am transferring within this date, then whatever deduction I am claimed will become my deemed income. Similar to what we saw in what? LIC. What did we say? Terminate within 2 years becomes your deemed income. Here, transfer within 5 years, it becomes your deemed income. So it becomes deemed income. Whatever you have claimed as deduction becomes your deemed income. So that is the provision for house property. Now, we'll just understand what exactly is allowed as deduction. We were talking about cost of the property, including stamp duty, registration fee, and other things. We said there must be a loan, right? There must be a loan. So only proportion whatever is being paid to that loan is allowed. So what the provision says is, you can pay principal, that is monthly principal. UMI is a monthly, equated monthly installment. So the monthly principal or part payment. Now I have extra 2 lakhs. I have a loan of 30 lakhs housing loan. I have 2 lakhs today. I think I'll go and pay it. Bulk payment. It's called as balloon payment. So I go and pay it and set off my principal. Such payment will go against the principal. So this 2 lakhs, whatever I paid as par payment is also allowed. But there are restrictions from to whom I am paying this. So it says I should have got that loan under self-financing scheme from a development authority, from an housing board or any other authority who is engaged in the construction and sale of house property. So I need to get a loan. From self-financing scheme, either from a development authority or a housing board or any other authority who's in the business of construction and selling of house property. So if they are into that business, any payment to them that is principal or part payment is allowed as deduction. Or I can also pay to a company or cooperative society who has given me that housing lower rate or whatever, because I'm a member of the housing society, I'm a shareholder of that company. So if that company, that housing company or that cooperative housing society is given me the house, if I'm paying to that is also allowed. So that is what is the second thing. So this is whatever I have dues, principal dues from these authority is allowed. Or the next category, repayment from what I have borrowed a loan from central government or state government. I have borrowed from any bank, including cooperative bank, national housing bank, life insurance corporation, all of them. So that is also allowed. Or from any public company, which intention is to provide long-term finance. When you say long-term finance, I give for a period of 15 years, 20 years. So it's for a long period. For what? Constructing an house. Or it could be a loan by an employer who, which is basically a board or corporation set up under central or state government. It could be a public company or a public sector company, or university, local authority, cooperative society. So there are too many things to remember, right? So typically we'll keep it this way. Okay, we'll try to understand it this way. There are two things that are eligible. One is your repayment, whatever you're repaying. Repaying could either be to a cooperative housing society or a company which you are part of, which has helped you get this property. So that's the first thing. Another is from a financial institution. It could be a bank or any financial institution which has given you housing loan. Sometimes your employer also could have given you a housing loan to say that you go and purchase the property. So your employer, your bank, will keep it simple as that. So it could be an employer, it could be a bank which has given you loan to purchase house property, or it could be some scheme or some authority who has given you loan. That is all you need to remember. So what are we going to remember? We are going to remember eligible authority, let's say eligible scheme. Eligible scheme is what we discussed here, plus bank, plus employer. So remember only these 3 points. So what is this employer that we are talking about? The employer could be government, could be a regular company, could be a public sector unit. So that's what we are talking about. And it could be institutions, educational institutions. So these are what you are calling as employer. So only these 3 people, that is eligible scheme, which is giving self-financing scheme, a bank which is issuing loan, an employer which is giving this. When I say bank, what did I say? It includes National Housing Bank and Life Insurance Corporation. So that is ATC. Okay, with this, we'll just stop here for a while, take a short 10-minute break, and come back and understand the other sections of ATC and rest of the chapter 16. So see you after the break. Yeah. Yeah, right, 10 minutes. Yeah. So welcome back. I'll answer a few questions before I proceed. So typically, what is admissible, what is inadmissible? So admissible is the one which is allowed as a deduction. Those expenditure or those things can be considered as a deduction. Whereas when you say inadmissible, they are not allowed as a deduction. So that's the point that we are trying to stress with respect to admissible and inadmissible. And then what about this principal payment? So we use the term principal payment, part payment, and we also said that it relates to repayment. So what are these terms? Yes, we'll keep it this manner. So we said you have a bank, a scheme, and an employer. So when a scheme, this area, whatever we are talking, is basically they provide you self-financing, a support for you to purchase a loan. Here also it is principal part payment. In loan terms, you call it as repayment. So it's almost the same, or probably we'll try to understand this way. Whatever is being repaid towards principal, whatever is being repaid towards principal is allowed as an expenditure. That's what we are actually calling as principal or part payment. So with that, probably we'll continue with the next. So we said we'll discuss about the rest of the ATC. So each of this is a particular clause. I'll just tell you what the clause is, what is basically the deduction that is eligible, and what are the restrictions in place. That is your what are the claims that you can actually, what are the things that you need to consider while claiming these things. That's what we are going to consider. The first one is deferred annuity. When you say deferred annuity, it's also possibly a insurance policy. So any premium paid, here you don't have the 10%, 15%, 20%, you don't have those categories, what we discussed for a life insurance policy. Here, whatever premium paid for individual, for the spouse or children is allowed. But only thing is, such policy for what we are paying should not have an option to receive cash payment in lieu of the payment of annuity. So which means I say that I'll keep paying annuity. At one point in time, you will start giving me cash. So that cash payment is not accepted. So receiving cash payment in lieu of this payment of annuity is not allowed. And similarly, one of the things is it need not be with an insurance company. So when you're talking about this annuity scheme, it need not be specifically with an insurance company. It could be with some other company who's issuing annuity also. So that's what is there. And there is a separate deferred annuity for government employees. So where whatever is a deduction from salary for payment of annuity, if a portion is deducted from by the employer, there is a government deducts certain portion as annuity, that is allowed. Only thing it is restricted to 1/5. What is 1/5? It's basically what? 20%, right? So it's a simple math. So 1/5 is typically 20%. Contributions to Provident Fund. There are three types of Provident Fund. You have recognized, unrecognized, and statutory. So there are three types, but only recognized and statutory is allowed. When you say contributions to Provident Fund, both the employer contribution and the employee contribution. Generally, in a Provident Fund, the employer says, on behalf of you, I'll pay 12%. Employee will say, along with your 12%, put my 12% also. This put together is only a Provident Fund. So if this Provident Fund goes into a recognized Provident Fund or a statutory Provident Fund, then it is eligible for a deduction under Section 80C. It could also be a public Provident Fund. Where you say maximum of 1.5 lakhs can be deposited in here. So maximum of 1.5 lakhs can be deposited in here. Only thing is, when you say this public Provident Fund, it can be in the name of individual or spouse or the children. If it's HUF, any member. So whenever we are talking about individual, if it is also eligible for this your HUF, then it becomes any member of that HUF. So that's when HUF, it is for any member. Next is contribution of SAF. What is SAF? Superannuation Fund. So this contribution to superannuation fund, any contribution by an employee to a superannuation fund is allowed as a deduction. There is no other points here to consider. So whatever is being paid is allowed. Now, if you actually speak about the superannuation fund, it is a kind of annuity provided by the employer only, but it is for very few people, that is key persons. It's not like whoever want they can go. Employer will provide to employee, selected employee, called a superannuation fund. So any contribution made to such fund by the employee is also allowed. Then you have triple S. Triple S basically Sukanya Samriddhi scheme. Sukanya Samriddhi scheme. So this scheme is basically for the girl children. So whatever is deposited in Sukanya Samriddhi account for the benefit of the girl children will be allowed as the deductions to whom the person who is depositing in the girl child name. Of course, no one, some will not be depositing for a stranger's girl child name. What is actually allowed is the parent, the individual who is depositing in the girl child, or the legal guardian. In case if there is a legal guardian, the legal guardian is depositing, it is eligible for the legal guardian also. So the girl child of the individual or the legal guardian. So that's what it is allowed. Next is the NST. It's called as National Savings Certificate. So any subscriptions made to that NST is also allowed as your deductions. See, these are all, there are too many clauses. Those I'm just going to list each one and tell you a brief explanation. That is more or less sufficient for what your understanding is required. So just know what are these deductions, the eligibility of these deductions. And then you have unit linked insurance scheme in the year issued based on the 1971 year. Whatever the contribution to such ULIP is allowed. It can be in the name of individual, spouse or child. In case of HUF, it can be NHUF. One of you had actually questioned this. So in case of ULIP, if the ULIP is terminated within 5 years or you have not revived the policy within 5 years, then in that case, it is not an eligible deduction. So whatever is there is deemed income. So whatever deductions you have claimed in that period till the time of termination or a failure to payment, that will be treated as deemed income. See, in this ATC, we'll be using this word deemed income here and there quite frequently. The reason is very common. Whatever deduction for that particular section on failure of certain condition, the deduction claimed will be your deemed income. So if some of you have been questioning what exactly is deemed income, so remember it this way. Deductions claimed till date will be your deemed income. So that's what you need to understand. So deemed income, where the policy is terminated, where your failure to revive within before 5 years. So that is with respect to ULIP issued by the 1971 or also for the LIC based mutual fund. So both these things, the contribution is eligible. It could be in the name of individual, spouse or children. If it's an HUF, it could be in the name of the member. If it's a terminated or failure to revive within 5 years, then that income shall be deemed income. So that's about it. Then other annuity plans. We saw deferred annuity plan for regular people and government employee. Any other annuity plan by LIC or anyone else, whatever contribution. Some of the plans are listed. So only thing is, it must be an approved plan. How as a student will I know whether that plan is approved or not? Simply, whatever is questioned in your examination will typically be an approved plan only. So we can keep it that way because institute probably doesn't go to an extent that they give you a ULIP annuity plan that is not approved by the central government. That's a very possible no scenario. So that's how I will actually treat it. So typical some of the policies listed in your study material are Jeevan Dhara, Jeevan Akshay and your EC Retire from Tata AG. So these are the policies listed in your study material. So just go through it. But of course, I'm sure that you will not be tested with a policy that is not listed in the study material at all. So these are the policies which is listed out in your study material. So that is annuity plan. And then you have notified units of mutual fund. Again, this is also central government comes out to the scheme and say these are notified mutual fund. So any subscription towards them is an eligible thing. And then you have notified pension fund by a mutual fund or a unit trust of India. So again, contribution. So if you actually see whatever I've been saying till now, the deduction is very simple. Contribution, subscription, contribution, subscription. So this is what you will learn. So these two keywords is what will actually be important for you. That is your contribution and subscription. Contribution and subscription. So these are the two key terms that are important for your entire ATC. The whole ATC what we are discussing, this only is important. So this is what we are going to discuss it right now, right? So now in this particular thing, this concept, this 80 easy retire is eligible towards whatever we are talking about. So notified pension fund, again, it is contribution to the individual is what we are talking about. The next one is contributions to National Housing Bank. Contributions to National Housing Bank. So what is a National Housing Bank? It's a bank extensively or exclusively set up for promoting housing projects. So any investment into it, they generally issue various funds. National Housing Bank also will issue funds. So if you are depositing into such funds, so again, contribution or subscription to any deposit scheme or contribution to pension fund is also eligible. So there is a separate scheme notified under this. Then you have additional account under NPS, National Pension Scheme. So National Pension Scheme is it's there for some 3-4 years. So this National Pension Scheme is basically a new investment option provided by the government with various additional benefits. We'll see when we are discussing 80CCD. So for now, we'll understand there are two types of accounts in National Pension Scheme. So 80CCD talks about Tier 1, 80C talks about Tier 2. So if there is a contribution to this Tier 2 account by the central government employee to additional account under NPS. So if an employee is contributing as a fixed deposit for a period of greater than 3 years, then whatever deposit that you're doing, the contribution to the deposit is eligible as a deduction under section under National Pension Scheme. The next one is tuition fees. So the tuition fees paid to university, college or school, the only condition is it must be an institution within India. So that's one of the critical things. So abroad studies are not covered in tuition fees. And then it must be a full-time education. It must be a full-time education and it is allowed for maximum of 2 children. Whatever is allowed is only a tuition fees. Any other fees, development fees, donation fee, building fee, whatever name you call, any additional fee is not allowed. What is allowed is only the tuition fees. So what is allowed is only the tuition fee component alone. It could be paid to university, college, school, or any education institution, any other educational institution. So what is allowed is a full-time education for maximum of 2 children. For example, take chartered accountancy. Chartered accountancy course is not a full-time education, right? So you don't go to a college or a school full-time to learn something. So when you say full-time education, it's something like your Bachelor of Engineering, your MBBS, or your Masters of Business Administration. So some course where you go to a college or university or a school and do it full-time. So that is what is allowed. Even your school fees is allowed till your 12th standard. Whatever tuition fees has been paid by your parents to your school is eligible under 80C. So that's what it is about. And when I say school fees, as I told you, what is allowed is only the term fees. That is the tuition fees. Anything else aparted collected from your school is not eligible for deduction. Certain units of mutual fund, again, it's relating to subscription. Whatever is an eligible company, eligible unit is allowed. Notified bonds by NABARD. So what is NABARD? National Agriculture Bond, Agriculture Bank for Agriculture and Rural Development. So National Bank for Agriculture and Rural Development. So any bonds issued by NABARD from this National Bank for Agriculture and Rural Development is also eligible. 5-year post office is eligible. So if you are making a 5-year time deposit, that is your 5-year fixed deposit. When you say time deposit, it will include fixed deposit or recurring deposit. So it should be for a period of 5 years. So 5-year fixed deposit will be eligible for deduction. And senior citizen deposit, there is a separate scheme called a senior citizen savings rule, which is actually whatever deposit is being made into that is allowed as deduction. But if it is withdrawn within 5 years, the deduction plus including interest, whatever amount you have withdrawn plus the interest accrued will be allowed as deduction. Generally, we say deemed income is what has been claimed as deduction, right? Here, it is not only the deduction, it is deduction plus interest. So here, deemed income is deduction plus interest. So typically, the total amount withdrawn becomes your taxable. Then you have 5-year term deposit, For here also, whatever term deposit, that tax saving deposit issued by bank is eligible for deduction. The maximum is 1.5 lakhs. So that's what this is all about. So other few schemes of ATC, notified deposit scheme. So if you're depositing in any public sector company, which is engaged in housing property. So the government intention, if you see, could be more towards housing. There are so many things that are related to housing, right? And then you have any such deposit relating to housing accommodation. So anything related to housing development or housing accommodation, if you're depositing into such notified scheme, then it shall be eligible. For example, you have this HUDCO, that is Housing Development Corporation. So that if they're issuing any public deposit, that is an eligible scheme. So basically what has been notified by central government is basically one of them is this HUDCO, that is Housing Development Corporation. So any deposit there is eligible as deduction under this notified deposit scheme. Certain equity shares are debenture. So not all investments that you are making in a share market, it's basically an eligible issue. So when a government approves a fresh issue of share capital through a proper scheme, certain issues are allowed as deductions. So investment into that is allowed, provided such shares cannot be transferred before 3 years. So there is a lock-in period of 3 years. So in case if you are transferring within 3 years, whatever deduction you have claimed becomes your what? We have been using this term repeatedly, will be termed as deemed income. So it will become your deemed income. So whatever amount has been claimed as deduction will be considered as deemed income. So the next thing is about, so that's all about ATC. So we'll move on to the next section, ATCCC. I'll just see if there are any questions for a while. Yeah, ULIP I've said, it is unit linked insurance plan. Difference between, deferred annuity, it's a scheme. Annuity is basically like there is kind of premium you pay. After a certain period, you start getting money from the scheme. You start getting a monthly payment to meet your retirement goals or something. So something like that is called deferred annuity. So, so that plan is also eligible under this scheme. Okay, so coming back to this ATCCC, so we'll see two sections on pension, two contributions on pension. When you say pension, you have two contributions. One is ATCCC, another is ATCCD. So that's what we are going to see right now. So this ATCCC is basically So this ATCCC is basically paid for annuity plan of LIC or other insurer. So it's a pension scheme. It's called a certain pension fund. So if there are certain pension fund which is linked with annuity. So in such pension funds, if you are depositing any paid for annuity plan or other insurer for receiving pension fund, the interest and bonus accrued are not contributions. If you actually see, whatever is being paid to annuity plan is allowed as deduction, but whatever is contributed towards interest or bonus accrued in that account, right? Okay, there is an account of pension. That account is like your savings bank account. What happens in savings bank account? You have an amount. There is a small interest that gets accumulated. That interest or any bonus is actually not contribution. Whatever is being paid towards annuity plan alone is allowed. So what is the maximum deduction? It is 1.5 lakhs. Now, what happens when you withdraw from that pension fund? If you actually see any credit balance, that is whatever is lying in the account, it could be interest, it could be bonus, it could be the premium that you have paid. So all this put together will become the deemed income, of the assessee when it is surrendered, when the annuity plan is surrendered or any pension is received from annuity plan. So typically, whenever the policy is surrendered and the amount is taken in full, then it becomes a deemed income. Or if pension is received from annuity plan, then it becomes taxable. So the credit balance includes interest, bonus, and every other payment in that account. Whatever amount that we are talking there will be eligible to to be treated as deemed income either at the time of surrender or at the time of pension received. The next one is pension scheme, that is 80CCD. So this is also a pension scheme. The difference between that is certain pension fund, basically issued from LIC or certain insurance company. Here, the pension scheme is notified by central government. So central government has currently notified Atal Pension Yojana. So Atal Pension Yojana is a scheme notified. They may also come out with other pension scheme. So it has been made mandatory for central government employee. So when you talk about a central government employee, it is mandatory. What is the contribution? 10% of salary by the employee, by the government. That is the employer. So there is 10% from employee, 10% from employee. This contribution is what contributes pension scheme. Whether if you talk about other employees can contribute, yes, very well. Not just employees, even self-employed. That is, it is available for everyone, the employees and also self-employed. What do you mean by self-employed? Let's keep it this way. Anyone who is not receiving salary income, but some other income. So when I say self-employed, not necessarily business, what I'm trying to tell you is it could be for business or any other income that they're getting. So basically any other individuals is eligible to claim into this, including the employees. So what is the deduction eligible? Deduction eligible is 10% of salary in case of employee. In case of employee, it is 10% of salary. In case of other persons who are not employee, it includes 20% of gross total income. So 20% of gross total income is an eligible deduction. If you actually see, I have just quoted deduction 1. This is subsection 1. So 80CCD 1 says employee can contribute 10% of the salary, or any other person can contribute 20% of their gross total income for claiming deduction under this particular scheme of pension scheme. So that's the first thing. The second thing is that deduction 2, the deduction number 2, that is subsection 2, we are talking about. Before going into deduction 2, I'll have to talk about 1B, that is subsection 1B. 1B says, apart from your eligible deductions in 80CCC, 80CCD, 80C, all that, you add another 50,000. So government is saying, whatever you are eligible under 80C, 80CCC, 80CCD, I'll give you another 50,000 if you have deposited. We'll see this through an example in the subsequent slide. So additional 50,000 is eligible if through say subsection 1B. So that is with respect to employee contribution. They are eligible for the deduction. If required, they are also eligible for another 50,000. So typically what happens is, let's take, I have deposited LIC of 60,000, okay? And now I'm making 80 CCD contribution under subsection 1 for, let's take 1 lakh. Okay. Total 80C eligibility, 80C CCD plus 80C, rule says you are only eligible for 1,50,000. Okay. They're eligible only for 1,50,000. So here the total is 1,60,000. So it is restricted, right? In case if it is restricted, government says use subsection 1B and claim the balance 10,000. So whatever is the left out can be claimed up to maximum of 50,000. So this is what 80CCD says. So 80CCD says, subsection 1B says you can claim another 50,000. So that's what this provision says. So this employer contribution, that is 80CCD subsection 1 and 1B. You have 80CCD subsection 2. So this 2 is employer contribution. Similar to your provident fund, the employee also can contribute, employer also can contribute. So this employer contribution is allowed as a deduction. For central government employee, it is 14% of salary. For others, it is 10% of salary. So that is what is available thing. So this central government can contribute 14% of salary. Other other employer can contribute 10% of salary. So this is called pension scheme of central government, Atal Pension Yojana, 80CCD 1, 1B and 2. what happens in every section? We have been seeing this concept of deemed income. Here also, if the account is closed, or you're opting out of the scheme, then if you're receiving that money, whatever money you're receiving, 60% is exempt. So section 10, what tells you when I say section 10? It is an exempt income. It could be wholly or partly exempt. So what does clause 12A says? Clause 12A says 60% of amount received is exempt. So that's what your clause 12A says. However, if it is on reason of death, then this provision is not applicable. That is, it is fully exempt. The entire portion is exempt. Only thing, if it is relating to closure or opting out or whatever you're receiving for that, 60% is exempt, 40% is taxable. And in case if you're not closing but just withdrawing the money from that, and if that withdrawal is less than or equal to 25%, does not exceed 25%, then it is exempt. If it crosses 25%, then that excess shall be treated as your taxable thing. So that is what the provision says. So typically, a deemed income is on two situations. One is closure or opting out. In that case, 60% is exempt, 40% is taxable under clause 12A. And then you have partial withdrawal. In partial withdrawal, if it does not exceed 25%, it is exempt. So anything above 25% will be taxable under this section, clause 12B. So that's what this clause is about. Moving on, if you add, we have been speaking about a limit, okay, the 1.5 lakhs limit that we have been talking. So typically the limit is specified in the section called 80 CCE. 80 CCE says maximum limit for you to claim deduction is only 1.5 lakhs. On what all is included in this? The first is 80C. 80C means your LIC, deferred annuity, your certain mutual funds, notified deposit scheme, savings bank, the senior citizen savings bank rules, post office deposits, 5-year time deposits. We saw so many, right? So those things are covered under your 80C. So all put together, your notified deposit scheme, certain equity, mutual fund, whatever is eligible under 80C, all put together is restricted to 1.5 lakhs. Then whatever we discussed in 80CCC, independently it is restricted to. So if you see the limit that I've specified here below is the independent limit. 80C independent restricts to 1.5 lakhs. 80CCC, that is certain pension fund, is restricted to 1.5 lakhs. 80CCD, 80CCD, the national pension scheme, the Atal Pension Yojana, is restricted to 10% of salary or 20% of GTA. These are independent restriction. 80C as an independent restriction, 80CCC as an independent restriction, 80CCD 1. Just note down this subsection here. I'll come back to that. So 80CCD 1 is also restricted to 10% of salary or 20% of gross total income. Now, all this put together can also be 1.5 lakhs. So whatever you do, they are not saying you are eligible for 1.5 plus 1.5 plus this. They are not saying this. They are saying overall you are eligible only for 1.5 lakhs. But you are additionally eligible for 50,000 under subsection 1B, whatever we discussed in the notes. Then apart from this, 80CCD2 is apart from that. So whatever employer contribution by central government, 14% of salary, for other employer, 10% of salary. Correct? So this is what the provision says. So all put together, it is 1.5 lakhs. Probably we'll put it this way. 1.5 plus 0.5 plus unlimited. When you say unlimited, it is actually limited to what? 14% of salary or 10% of in case of others, right? So this is the overall limit that you can claim under these sections. So this is specified in section 80CCE. So we have been using this word, right? 14% of salary, 10% of salary. So what is this salary? So the salary is basically basic salary plus dearness allowance forming part of retirement benefit. in most of your salary workings, wherever you're computing something, be it HRA or whatever, typically what happens is it is salary plus dearness allowance forming part of retirement benefit. This only is called as salary. Only very few sections as few more component as salary, but most of the sections, what does salary mean? It is basic salary plus dearness allowance forming part of retirement benefit. So these are the things that we need to consider. Now we'll see a small exercise problem to understand this particular limit of 80cc or whatever. So the basic salary of Mr. A is 1 lakh per month. He is entitled to dearness allowance, which is 40% of basic salary, which means 40% of basic salary is his dearness allowance. 50% of that dearness allowance forms part of retirement benefit. So which means 40%, 50% is that. So we can keep it as 20%. So 20% comes as retirement benefit. They are contributing 15% of basic salary. So the employer is actually contributing 15% of basic salary. So we'll just understand how this works. So this basically works basic salary, right? Basic is 1 lakh. Dearness allowance forming part of retirement benefit. 50% into 40%, correct? So what is dearness allowance is 40%. 50% is only forming part of retirement. So in that case, this will be 20,000 per month. So it's 1,20,000 per month. So which will be like what? 14,40,000 per annum. Now, but what is the employer contributing? Employer is contributing on 12 lakhs. That is 1 lakh into 12. So that is your annual basic salary. In this, he is contributing 15%. So how much is this? It is what? 1,20,000 plus 60,000. That is 1,80,000. Now, this is what has been contributed. But 80CCD2 says for any other employer, the maximum allowed is 10%. So this into 10% is only allowed. So how much is allowed? 1,44,000 is only eligible under 80CCD2. Clear? So let me repeat. Your total, whatever employer has contributed is on basic salary. So this working, whatever we are doing here is on basic salary. Whatever the employer has contributed, that is 1 lakh into 12 months. So 12 lakh is your basic salary. The employer has contributed 15%. So it is 1,80,000, right? So that's the thing. The next thing is, whatever we are discussing here is 14,40,000 is after considering dearness allowance. So in that, maximum eligible is only 10% of salary under 80CCD2. So what we are allowed is only 1,44,000. So that's the working that we need to do for this particular thing. Okay, so that is what the understanding of 80CCD2 along with 80CC is. So in 80CC, you can claim additionally for 80CCD2. Clear? So we'll work out another problem to understand this limit specified under 80CC, because there are so many limits, right? 80C says 1.5 lakhs, 80CCC says another 1.5 lakhs, 80CCD says you can invest a percentage of your salary, all those limits. So all those things put together, you are eligible only for 1.5 lakhs. So that's what 80CC is about. So we'll see this problem. Typically, we'll keep the year as assessment year as 22, 23, and this is what 21, 22. Just for the sake of your examination, that's how they compute. So the contribution to PPF is 1.1 lakhs. That's the first thing. And then tuition fees is 45,000. It is for students studying class 11. Then there is a repayment of loan taken from Standard Chartered Bank, contribution to approved fund, pension fund of LIC. So that is 80CCC. Okay. So we'll now work out. How do we work out? Probably we'll work out here itself. So we'll first take PPF, which is 1.1 lakhs. Then you have tuition fees. That is what, 45,000. Then you have housing loan. So repayment of housing loan from a bank. There are three persons allowed: a scheme, bank, and employer. So this is from a bank. So it is allowed. So this is what, 25,000. So total is 1,80,000. 80C is restricted to 1,50,000 because 80C is independently restricted to 1.5 lakhs. Then you have pension fund, 80CCC pension fund. How much is it? 1,05,000. So this is exactly allowed. So for 80CCC, you have 1,05,000. So total is 2,55,000. Correct? 2,55,000. It is restricted to what? 80CCE restricted to 1,50,000. Right? So this is the maximum deduction that you can claim because 80C says 1.5 lakhs, 80C says 1.5 lakhs only restricted. So though you have invested for 1.8 lakhs, you're only eligible to claim 1.5 lakhs under 80C. 80CCC also you're eligible for 1.5, but here what is invested is only 1,05,000. So you take that whole amount. Now this put together you are getting 2.55 lakhs. But how much of that is allowed? Only 1.5 lakhs is allowed. So in short, under 80CCE, all put together, that is 80C, 80CCC, 80CCD, subsection 1, you are eligible for 1.5 lakhs. 1B, another 50,000. And then after 1B, we also have this 80CCD2, which is 14% of salary for central government employee, 10% of salary for private employees. So this is all about 80C. So I'll answer some of the questions before we move on to the next sections of 80CCD. The ULIP lock-in period for this ULIP 1971 and the certain policies, it is 5 years. The lock-in within 5 years, if you are selling, it becomes taxable. 80CCD is basically for a pension scheme that we discussed. Salary for 80CCD, I guess we discussed, right? It is basically Rohini, it is about 80CCD salary, basic salary and dearness allowance. 80CCD subsection 2, yes, it is not part of 80CCE, it is additionally allowed. Yeah, the additional 50,000 is restricted only to 80CCD2. So the additional 50,000 is only restricted to this 50,000 is only for NPS. It is not eligible for anything else. So you can't use this 50,000 here or here. You can't use that. So this is not allowed. So what is allowed is only contribution to this NPS fund only, that 50,000 is eligible. Yeah. Okay, Ashish, if the dearness allowance does not specify whether it's forming part or not, one of the most important thing, I guess all of you have to give importance to this question, because one of the most important thing in the examination in income tax question paper is called assumption. So this assumption is very important in Income Tax Act because this assumption might overturn the entire value. As requested here, if dearness allowance is considered to be part of retirement, the answer will be different. If the dearness allowance is not considered to be forming part of retirement, the answer will be different. So if the question does not provide whether it forms part or not, you'll have to make an assumption. Now, which way of assumption is correct? Is it right to make forming part or not right to make not forming part of? I would say both are right, but be very clear. Be very clear in what you're assuming and make sure you're writing a note. So assumption is very critical. Assumption is very critical in exam. So it is very critical for examination. You should make sure you make the assumption and make sure you write as a note. So note. So you add a note and write your assumption. You say dearness allowance is considered to be 100% of dearness allowance is considered to be forming part of retirement. So this is very important as far as your examination goes. Please be very sure. Examination problem mandatory requires note, because note helps the valuer understand. Let's take this example. Now, as a student, you have written a note saying 100% of dearness allowance is considered to be forming part of retirement. You have written this as a note. As a valuer, I would now know, you know the provision. Now I get a confidence that Ashish has written this provision knowing the provision. I will have a better understanding, right? Better value on this. So this is what is very important as far as the examination is concerned. So this is very critical as far as your question paper goes. So as far as your examination goes, make sure you are writing the notes. So that is very critical for your examination. So I guess that's all the question is about. Yeah, there are, as I told you, yes, these are big provisions, but yes, the provisions are very small. So the total limit is very small. We read about so many provisions and we say all this put together, you are only eligible for 1.5 lakhs. Yes, that's how the provision is. So hope that we are done with that. So we'll move on to the next session. That is your 80D. So 80D is medical insurance. We'll keep D for disease, okay? So 80D is medical insurance. So this medical insurance, the first thing that we need to understand is what are all eligible things. So what is eligible is medical insurance and central government health scheme. So any contribution to this for a medical insurance or for a central government health scheme is allowed as a deduction under section 80D. For family, that is, your premium can be for the family. What do you mean by the family? We have already seen this. Individual, spouse, children. In 80D, when you say children, they only refer to dependent children. They only refer to dependent children. So it is only DC. So earlier we said any child, right? Any child in so many provisions. So that is AC. Here we are trying to say it is DC. That is only for dependent children. So that's what we are going to understand. So it is for self, spouse and dependent children, DC. How much is eligible? 25,000. If the individual is a senior citizen, it goes to 50,000. And insurance, this medical insurance is also eligible for parents. For parents also, what is eligible is 25,000. If they are a senior citizen, what is eligible is 50,000. If the parent is a senior citizen, it is 50,000. If in case of Hindu undivided family, what will be the provision? It is 25,000 for self. And in case of any senior citizen, any member in the senior citizen, HUF has Karta and members, right? So if any member is a senior citizen, the maximum eligible limit becomes 50,000. So that what is the provision is about. That is, you are allowed as an assessee, you are allowed to deposit medical insurance premium for the individual, spouse, dependent children or parents. If one of them is senior citizen, it becomes 50,000. 50,000 for self, 50,000 for parents. So that is what you divide. So you divide it into two categories: family, parent. Family, it is 25,000. In case of senior citizen, 50,000. Parent, 25,000. In case of senior citizen, it's 50,000. Even if one parent, if there is father and mother, if father at least is more than senior citizen, they are eligible for 25,000. So it is whatever that we are talking about, the premium of that person. If you are doing it premium on mother, parent is a mother, you need to consider mother's age. If you are considering for the father, you have to consider the father's age. So depending upon that age only, you consider this 50,000. So that's what this provision is about. But for parent put together, it is 50,000. Parents put together, it is 50,000. It is not about one parent. 50,000 whole parents, 50,000 whole family. So that's what the provision is about. So coming back to that, the next thing is health checkup. Not only insurance premium, you can also do a health checkup, the annual health checkup. You can do it for self, spouse or the dependent children. The maximum limit allowed is 5,000. But this 5,000 is not excess. 5,000 is within the limit already specified, either 25,000 or 50,000. So you can do 5,000 as an additional health checkup for the self spouse and dependent children. There is another category recently introduced this couple of years before. There is a medical expenditure allowed. If you actually know about this medical insurance, if you actually see, there will be scenarios where this medical insurance will not be eligible for senior citizens because they are already affected with some illness. So that will not get covered in the medical insurance. So the medical insurancer will say, you cannot insure under my policy. So now senior citizen is in a situation where they can't take medical insurance itself. So to help such senior citizen people, government came out with the scheme of said, if you do not have insurance and you're still making medical expenditures, you are eligible for 50,000. So that is an additional benefit given to senior citizens alone. Another important condition in this medical insurance is the way you make the payment. As far as this health checkup goes, at 5,000, it doesn't matter. You can give cash, you can do UPI, Google Pay, whatever you want, you can do for that 5,000. But when it comes to any other mode, that is your medical insurance premium or even this medical expenditure. So for everything that it has to be paid by mode other than cash. So it can't be paid by cash itself. Anything other than cash. When you say anything other than cash, it need not be account payee check, right? When you say electronic mode of payments, generally it says account payee check. But here that is not the case. It must be paid through banking mode. It can be a bearer check or electronic check or whatever. It has to be no cash. That's the point. There is nothing else to discuss about it. Whatever is paid for premium, for medical expenditure, where no insurance is there, in that case, it should be paid by a mode other than cash. That's the only point, nothing else to worry about. So that's the thing. There is one more category. In some insurance policies, the insurance policy could be one premium for several years. Let's say I paid for 5 years. I pay 50,000 for 5 years. Now, what is eligible is 10,000 per year. That is 50,000 divided by 5. So that is how you do. So 1 divided by relevant previous year. So that is how you calculate. So the formula for calculation is not something very big like some very heavy mathematical formula. There's nothing like that. You just apportion for every year equally. So if you're doing for 5 years, divided by 5. So divided by the number of years for which the premium is relevant. So that's the provision is about. Okay. So we'll just see a small question relating to this. So Mr. A is age 40 years. So why is his age relevant? We are trying to say that the person is not a senior citizen. So for him, that is for self, spouse, dependent children, what is eligible? Only 25,000. 50,000 is not eligible. So that is the reason for this age. Paid medical insurance premium of 20,000 during financial year 2021 to insure his health as well as the health of his spouse. It is allowed. So what is allowed is self, spouse and dependent children. He also paid medical insurance for 47,000 during the year to ensure the health of his father is 63 years, who is not dependent on him. He contributed 3,600 to central government health scheme. During this he has incurred 3,600 for him. He incurred 3,000 in cash on preventive health checkup. So that was also done for himself and his spouse. 4,000 by check on preventive health checkups of his father. So these are the total expenditure. So now let's go by one. So now the provision says we need to calculate insurance. So when you say insurance, you take self and spouse and then parent. Then you have, probably we'll put it this manner. So we'll first calculate for self and spouse. First is insurance. And then you have CG scheme. And then you have health checkup. So these are the possible things that are allowed. So now what are the things that is allowed for in this particular manner? So in this, what we are saying is insurance is allowed. So what is the insurance? Whatever he has paid as insurance premium for this particular manner. So what is the insurance that he has paid? He has actually paid for how much? He has paid for 20,000 during the previous year of for his health and spouse. So the amount is 20,000. So the first insurance that we are considering is 20,000. Then he has also paid for central government scheme. So what is central government scheme? He has paid off how much? 3,600. So he has paid for 3,600. So that's the thing for that. And then you have health checkup. How much is health checkup? 3,000 in cash. So 3,000 cash is allowed, right? So put together, it is 26,600. So that is the total benefit, right? So that's the total benefit allowed for particular person. Now we'll have to come to the parent. What is the parent doing? As far as the parent goes, we'll write for parent. Again, we'll write insurance. We'll write central government scheme and health checkup. We'll see how is the eligibility for these three things. So when it comes to insurance, they have added a word. They have added a word who's not dependent on him. Is that relevant? Is that relevant? See, you have to see the question paper very clearly because certain terms might confuse you. Now you would have been thinking 80D is eligible for self, spouse, dependent children and parents. Moment the word comes not dependent, your mind starts thinking, now is it eligible or not? Did I read the provision as only for dependent or not dependent? So we'll have to be very clear in this concept. As far as 80D goes, only the children is about dependent. As far as the parent goes, it doesn't matter whether they are dependent or not. So being more than 67 years old, what is eligible? What is eligible is 47,000. So up to 50,000 is eligible. So it doesn't matter whether they are whether they are dependent or not. If it's a parent who's a senior citizen, it is allowed. So the next section that we are talking about, the next section, next issue we are talking about is there is no central government scheme. 4,000 for preventive health checkup. So this is nil. This is 4,000. So what is the total? 51,000. So what is maximum eligible? It is only 50,000. So the insurance total 80D will be 26,600 plus 50,000, resulting in 76,600. So this will be the total deduction, the allowable. Sorry, I just missed it out here. So here what is maximum eligible is 25,000, right? So 25,000 plus this is 75,000. So maximum eligible is 75,000. So because the other person is not a senior citizen, so it is only restricted to 25,000. So that's how you do it. So 25,000 for self, 50,000 for parent. So 75,000 maximum eligible. He has actually taken care. So that is the provision about. So moving on, we'll move on to 80DD. So 80DD stands for dependent disabled. So a person is disabled and dependent on a particular assessee. Only then this 80DD comes. So here also it is for certain treatment or insurance, whatever it is. It is about first thing is eligible assessee. So what is an eligible assessee? It is individual or HUF. So if it could be an individual or HUF, they may be a resident. They must be a resident and who is dependent and disabled. So that's the provision. So typically, individual or HUF, a resident individual or HUF, it doesn't talk about ordinary, not ordinary. It only says resident. So dependent and disabled. So who is basically dependent? Whom do you call someone as dependent? So it could be a spouse, it could be a children, it could be a parent, it could be a brother, it could be sister. And what do you mean by dependency? Either completely dependent or mainly dependent, which means without their support, they will not be able to lead an independent life. So that's what you mean, call it as mainly dependent. In case of HUF, it is member of HUF. So that's what you mean, call it as 80DD. So the individual or HUF, resident, dependent, disabled, dependent spouse, children, parent, brother and sister, whether wholly or mainly. In case of HUF, it is member. So what is the eligible expenditure? Any medical treatment, training, rehabilitation, any of this is included. When you say disabled, not only your physical disability, if there is something categorized as mental disability, something like your autism, cerebral palsy, or multiple disability, all this is also covered under this 80DD. So this disability also is covered. We can call it as disabled or differently abled as the term goes. So whatever it is, the provision uses the word disabled. So as far as the disabled goes, it is physically disabled, mentally disabled. So this is also covered. So what do? They may either treat for medical, training, rehabilitation, or pay for anything, that is insurance or whatever. They could pay for that also. Only thing is, if it is relating to payment of annuity or lump sum on individual's death, it can come back to dependent or nominee. So the policy, whatever is entered, the condition should be that the policy's money in case of any death should go to the dependent or the nominee of that policy. And a certificate should be issued by the medical authority to provide to what extent they are disabled. So that is the condition. So typically we are trying to say that there is an eligible expenditure either for medical treatment, training or rehabilitation or payment towards any scheme. It also includes mental disability. The only condition is the policy for which they are paying should have a clause which says the money after my death, after the individual's death, should go to the dependent person or the nominee provided there. So that is what is there. What is the deduction eligible? It is a flat deduction. It is a flat deduction. There is no about expenditure or something. So if the disability is over 80%, then it is 1.25 lakhs. If the disability is less than 80%, then it is 75,000. So that's a provision. So the only thing is we need to certify the percentage of disability, but considering currently it is all e-filing, right? Electronic filing. You don't have a provision to upload this medical certificate, so you'll have to keep it. In case of the assessing officer, in case the income tax department requires you to submit, only then you submit. So that's what it is. So we'll see this exercise 5. It is a resident individual. He deposits the sum of 50,000 with LIC every year for the maintenance of his handicapped grandfather who is wholly dependent upon him. The disability is one which comes under the person with disability. So it is there. A copy of the certificate is also submitted. So now they wanted to know the 80DD for assessment year 2022-23. What will be the deduction if Mr. X has made deposits for his dependent father? So they're asking what happens when he's actually depositing or what happens he's actually treating it. So the only thing is it could be any payment for any reason or whatever. The only condition that they say is there must be some expenditure incurred for this. So whatever you're doing is actually eligible under 80DD. So this entire amount, whatever you're saying, is eligible. So the only condition about here is, if you actually see the relationship specified is spouse, children, parent, brother, sister. But the question speaks about the word grandfather. Though they say wholly dependent, they say it is for the grandfather. So what happens when it is for a grandfather? 80DD is not eligible. So what will be the reduction if he has made a deposit? Doesn't matter. Since it's grandfather, whether he is making a deposit or not anything, it is still okay. But as far as 80DD goes, if you have made any kind of investment against that policy of that member, you are eligible. Only thing, it must be for the person specified in the provision. That is spouse, children, brother, sister, and parents who are wholly or mainly dependent. So that's the provision. Next section is 80DDB. This is again, this DDB is for specified diseases. So if the resident for individual HUF, there is a specified medical expenditure incurred, same as 80DD. That is spouse, children, brother, sister, parent, who are wholly or mainly dependent. So the relationship is same as 80DD. What happens is, if there is some investment made for this medical treatment, if there is something insurance or any kind of expenditure, actual amount of 40,000. If you actually see in 80DD, it was a fixed thing. So above 80%, it is 1,25,000. Less than 80%, it was 75,000. That's what we saw. So whatever we are seeing here is fixed. But here it is not fixed. It is paid or 40,000, whichever is lower. If it's a senior citizen, it's paid or 1 lakh, whichever is lower. So reduce amount received. In case if some insurance company is paying some money or employer is paying back, you'll have to reduce that. So whatever is your expenditure, that is own expenditure, that alone is claimed. Whatever is reimbursed should not be considered. So that is not there. So medical expenditure is typically, they must get a prescription from neurologist, oncologist, urologist, hematologist, or immunologist. So these are the specified diseases, doctors who come under these specified diseases. So if these category of persons are actually doing a medical expenditure, then whatever expenditure you make, or 40,000, in case of senior citizen, whatever expenditure you make, or 1 lakh, whichever is, the payment or the deduction, whichever is lower, will be claimed as a deduction. So that is about 80DDB. So I'll just see if there are any questions on 80D, DDB, and TD. Vrinda, typically 14%, I've already told. If it's a central government employer, they can contribute 14% on salary as national pension. So that is there. And Jay, what is admissible and inadmissible? I've already told this also. In housing property, admissible are certain nature, inadmissible is certain nature. The slide was self-explanatory there. If individual and spouse is senior citizen and parents also senior citizen, Pooja, then they are eligible for 1 lakh. So you are eligible for senior citizen of 50,000 for self, 50,000 for parent. So in total, you are eligible for 1 lakh in case both are senior citizen. Namrata, bearer check is allowed. So bearer check is allowed. So what is SSDC? I've already specified at the top of the slide. It is self, spouse, dependent children. So that's what SSDC is. Basically, it is allowed for your own family member, including a dependent children. So that's what it is there. For 80D, dependency is not important. So Kushi, it doesn't matter whether the particular parent is dependent or not. 80D is eligible for everyone. Spouse, children only must be dependent. For a parent, it is automatically appearing. Yeah. I have just 3 sections more for today so that we'll do that, because these are all the basic sections, because there are a lot more chapter 6A deduction that needs to be covered in the next class also. So we'll see 80E, which is related to education, So the eligible assessee is individual for his education. So loan for pursuing higher education, loan may be from financial institution or approved institution. So that is also allowed. And then you have, it could be for self or relative. So it could be either for themselves or the relative. What is the relative? It is spouse and children. In case of as legal guardian, the student of which he is a legal guardian. So that is what is included. So the individual can claim the educational expenditure of self or spouse or children, whatever is being received from the financial institution, loan obtained from financial institution. It can be any course after class 12. It also includes vocation. Vocation is basically art form. You have regular profession, vocation. Vocation is art form and something related to that. So that is what is covered in that. Interest on loan paid, first year, whatever interest paid is the deduction allowed. And it is eligible for close to 8 years. That is first year plus 7 succeeding years. So it is totally eligible for 8 years. So that is the total thing. We'll see the small example. B has taken a loan for B, for son of B, for daughter of B. Here it doesn't talk about the word dependent. So it is basically eligible for any children. So it is for purpose of MBA, BSc, BA. So all are actually higher education, right? Pursuing higher education only. So all this is basically allowed as your expenditure. Now we need to see who gave. That is whether a particular person gave or whoever has given that thing. So what is actually eligible is amount of loan, 5 lakhs, 2 lakhs, 4 lakhs, annual repayment is what they have given, annual repayment of interest. So this is what is actually we are considering. So we need to see whether, as we said, all three are eligible because all are for higher education, that is above class 12. So what is eligible is 20,000 plus 10,000 plus 18,000. So totally it is 48,000. So this is the total eligible thing under 80. So that's about 80. It's simple, right? It is for loan obtained from financial institution for the purpose of pursuing higher education, either for self or spouse or children. And in case of legal guardian, for the person whom they are legal guardian. So that is what is there. Interest is the eligible expenditure as deduction. Whatever interest paid is eligible as deduction. There is no limit and all. For the first year plus 7 years, that is 8 years. In total for 8 years, that is total eligibility is 8 years. So that's the total thing. So next is 80E. You already have housing loan interest under section 24B, right? Self-occupied up to 2 lakhs. All this is there. So now, apart from that, government, as I have been always telling you, government intention is to promote people buy more houses. That is, when you say more houses, make people have at least one own house. So that is the interest. So this eligible assessee is basically an individual who has obtained a loan from residential house to purchase, loan from financial institution to purchase residential house. So what is the condition? On that date in which loan has actually been approved, there should be no other house. So that should be the first house. On the date on which loan is approved, that must be the first house that they are purchasing. And the value of house should be less than or equal to 50 lakhs. That is, does not exceed 50 lakhs. Value of loan does not exceed 35 lakhs. And the loan must be obtained in previous year 2016 and 17. That is between 1st April 2016 to 31st March 2017. Interest on loan, what is eligible as deduction? Up to 50,000, not up to 50,000. If you have yes, in fact, it is up to 20. It is up to 50,000 is what is eligible for the entire period of loan. It is not 1 year or 2 years. It is for the entire. If your loan period is 20 years, you are eligible for the entire 20 years. It is over and above section 24. So you are already eligible for 2 lakhs here. Above that, you can claim this 50,000. So it becomes 2 lakh plus 50,000. So principal is eligible and under section 80C. Principal is eligible under section 80C. Interest is eligible under section 24B and 80EE in case situation. So that's what is there. So this is what is the question there. We'll probably understand this particular issue on this question to understand this section a little in detail. So Mr. A has purchased a residential house, right? Mr. A purchased a residential house. So this residential house, whatever we are talking here, is a self-occupation. That is, he's actually occupying as a self-occupied property. So this self-occupied property, we said he has to buy a residential house. So now he has bought this residential house at a cost of 45 lakhs. So what should be the maximum cost allowed? 50 lakhs. When has he purchased? On 1st April 2017. 1st April 2017. But the question provides, the provision provides loan during previous year 16-17. That is between 1st April 2016 to 31st March 17. So it doesn't matter when the house is purchased. It is about the loan. Loan is provided. Loan of 35 lakhs from bank at 11% on the same date. The loan was sanctioned on 28th March 2017. So what is important is only the loan sanction date, the date in which loan is actually sanctioned. So now what happens? He will be typically, we need to calculate the interest. So he has obtained this loan on 28th March 2017. So we'll have to calculate 11% interest. So we'll just do this problem. So loan amount is 35 lakhs into 11%. So that will be 3,50,000. 3,50,000 plus 35,000, right? So it will be 3,85,000. So 3,85,000 will be the interest. In this section 24, you are eligible for 2 lakhs, right? You are eligible for 2 lakhs. 80EE says if your loan is obtained between 1st March 16 and 31 March 17, then you are eligible for additional 50,000 maximum. What is eligible here? That is 1,85,000. That is nothing but 3.85 minus 2. So that's how you get this 1,85,000. So for this 1,85,000, you are only restricted to 50,000. So your total eligibility of interest will be 2,50,000. You will claim 2 lakhs here. You will claim 2 lakhs in 24 and 50,000 in chapter 6A. So that's the provision for this particular section. Clear? So now, if you actually see, this is only for which year? Previous year, 16-17. It is not for any other period. So government came up and said, introduced another section. They introduced another section called 80EEA. This they introduced from financial year 2019-20. So financial year 2019-20 to financial year 2021-22. So for this period, if you are obtaining, everything remains the same. Okay, there are very few changes between 80EE and 80EEA. There are very few changes. This is also for individual only. It can be obtained from a financial institution or housing finance corporation. He must buy a residential house. No change in that. That must be his first house. So no other house on loan date. That is also same as 80EE. There is a small change. Here we use the word value as 50 lakhs. Now they have reduced it 45 lakhs and they have brought this concept of stamp duty value. So here they are not saying value of the house. When you say value, the question comes whether what I pay or the stamp duty value, which value. So now the question is very clear. It says stamp duty value does not exceed 45 lakhs. And it is not specifying any loan amount. Earlier there was loan amount of 35 lakhs. Now they're not specifying the loan amount. They're just saying loan must be obtained for this property. It must be obtained between this period, that is 2019 to 22. It must not be eligible under 80E. If it are already claimed under 80E, this provision is not applicable. What is the quantum of deduction? 1.5 lakhs of interest for the entire period of loan. You are already eligible for 2 lakhs in section 24B. Now you are again eligible for another 1.5 lakhs. So this is over and above section 24. So that's the additional vehicle, right? So additional contribution. We'll see the next 80EEB and go to a problem. So 80EE is for house property loan obtained in previous year 2016. 80EEA is for loan obtained, housing loan obtained during the period financial year 19-20 to financial year 21-22. So that's the whole period that is eligible. The next section 80EEB is basically for individual only. Loan is obtained from financial institution or non-banking financial corporation. NBFC stands for non-banking financial corporation. What are they buying? They are buying an electric vehicle. So typically EEB stands for electric vehicle. The loan must be obtained between 2019, that is financial year 2019-20 to financial year 22-23. So this was the 23. The year 23 was very recently amended, but this provision as such came in Finance Act 2019. So this interest, whatever interest, should not be allowed under other section, which means if the interest is actually allowed as a deduction in any other section, then you cannot claim it. If you are doing a business, interest paid on loan is an expenditure claimed there, then deduction is not allowed, right? So it is only for probably persons who are not doing business. And he is eligible up to 1.5 lakhs for the entire period of loan. So this is about electric vehicle. So here, what matters is the key dates. Loan provided. Loan provided is the key date in every section. That is, in all the section, 80EE, EEA, and EEB. In all these sections, the key date is the loan date. There we said loan must be provided after 1st April, between previous year 2016. So between 1st April 2016 to 2017. For a housing loan 80 EEA, what we are saying it is between 1st April 19 to 31st March 2022. For EEB, it is also 1st April 19 and 31st March 2023. So these are the three provisions. We'll see a problem to understand this section a little more detailed. So there are 4 persons, A, B, C, D. A is basically as a amount of loan taken is 43, 45, and 20 and 15. What for what? They have taken it from Housing Finance Corporation, NBFC, Public Sector Bank. So these are the 4 things, okay? Date of sanction loan date is provided and date of disbursement of loan is provided. Now what is relevant is whether sanction date or loan date. So that's what we need to see. Purpose of loan. This is for these 2 are for property, these 2 are for electrical property. They have also given the stamp duty value for us to understand whether it is within the limit. So what is the stamp duty value considered? It is 45 lakhs. So the stamp duty value should be lesser than or equal to 45 lakhs. They have also given the interest rate, cost of electric vehicles. So these are the information that is provided. They're asking us to compute the deduction under A, B, C, D. So now what is the thing? In these 4 things, whatever we are talking about, that is A, B, C, and D, whatever we are talking is typically A, B, C, D, right? So we are going to talk about 4 people only. So what is the thing that we are talking about? A is obtained for housing, electric vehicle, and electric vehicle. So these are the 4 things that is concerned. So as far as A goes for what is the loan obtained? It is for housing property. The loan amount should be less than for the property value should be less than 45 lakhs, and the period of distribution should be within what period? Should be within the period specified, whatever we are seeing, that is for 80 EEA, it should be between financial year 2019-20 and financial year what period? So financial year 2019 and 31st March 2022. This loan is only in 1st April 2021. So the loan period is only in 2021. So this is an eligible because it is between financial year 1st April 2019 to 31st March. So this eligible period is 1st April 19 to 31st March 22. The actual loan obtained is only 21. So it is eligible. How much is eligible? 43 lakhs into the interest rate. What is the interest rate? 9%. So the total is typically 43 lakhs into 9%. What will be the amount? It will be what? 3,60,000, 3,87,000 if I'm right. Please correct me if you're wrong. So it is 3,87,000. Okay, 9% from April 21, correct? So 9%. The loan is actually disbursed only in 1st May. So the period has to be into 11/12. So it should not be 3,84,000. It should be lesser. Probably I'll compute. Give me a second. So 4,80,000 into 9% for 11/12. So it is 43 lakhs. 43 lakhs into 9% into 11/12. So it is 3,54,750. So what will be eligible is 2 lakhs in 24 in section 24 and 1,50,000. 1,50,000 in 80 EEA, right? 80 EEA will have 1,50,000. So that's the eligible. So out of 354,750, you are claiming 3,50,000. So that is for A. What for B? As far as B goes, it is not eligible, right? Because the loan amount is also 48 lakhs. The loan amount is 45 lakhs. That is allowed, but it is in NBFC. So when you say NBFC, whatever you are talking about is what? It is only restricted to financial institution, because whatever you are talking about in 80 EEA, the loan should be from financial institution or national housing corporation. NBFC is not allowed to claim this additional deduction. So you're only eligible for the basic deduction of 2 lakhs. Because what? NBFC is not allowed. NBFC is not allowed for 80 EEA. So we are not considering 80 EEA. And the stamp duty value, whatever the property they have given, is how much? 48 lakhs. The stamp duty value should be less than or equal to 45 lakhs. So that's the reason. So though this satisfies, this does not satisfy. So that is the reason why the additional provision is not allowed. But however, this your concept of this this 2 lakhs under section 24 is allowed. So that is allowed. So that is for B. What about C? As far as C goes, the only thing is it can be taken from financial institution or national banking, NBFC, non-banking financial corporation. It must be taken between what period? 1st April 2019 to 31st March 2023. So this is also allowed. So it must be taken between 1st April 19 to 31/3/23. So it is allowed. The loan is taken only from that period. So what period it is taken? 20 lakhs. The cost of electrical vehicle is 22 lakhs. So 20 lakhs is the loan amount. 20 lakhs is the loan amount. What is the interest rate? 10%. Loan is allowed for how many months? For the entire period. So that is 2 lakhs. So this 2 lakhs will be allowed as the total interest. But the maximum allowed is how much? Maximum allowed will only be 1,50,000. So because your maximum eligible under section 80 EEB is only 1.5 lakhs. So you are not allowed to claim beyond that. Okay, what about D? He has taken it from a public sector bank. On what date? 30th March 2019. What is relevant is the loan sanction date. So if he's actually taking it from 30th March 2019, 30th March 2019, in that case, what happens is it automatically becomes nil because it must be between the period 1st April 2019 to 31st March 23. So this is beyond, this was actually given on 31st March 2019. So this is not eligible. Clear? So that is all about your provisioning. So that is what we have covered here. So probably we'll just see some 5 MCQs before we wind up the thing. Before that, I'll answer a few questions. In 80 DDB, if the disability is more than 80%, it is 1 lakh. It is not 80 DDB is not about disability. 80 DDB is about specified diseases. So if it's a senior citizen, it is 1 lakh. If it is not a senior citizen, it is 40,000. 80 DD is only for the disabled person, where disability more than 80%, it is 1.25 lakhs. For others, it is 75,000. Education available outside India is not allowed. It must be a full-time. It must be an. So whatever 80E talks about, if you actually see, the section is very plain. It only says about it must be for anything course after senior secondary equivalent. So that is only there. So it is about any course, but it should be only a full-time course. So it cannot be a part-time course. So hence, in case if it's a full-time course, it's any course outside India also will be allowed. Why is there a separate section for 80E only for 1617? Yes. See, they first introduced the section for 1617. Then after 2 years later, they wanted to have a new section with a higher deduction. That is, from 50,000, they wanted to provide 1.5 lakhs. So they introduced a new section called 80EEA. So that's why there are 2 different sections. So otherwise, I guess I've answered all questions. So and one more thing is some of the questions on how to remember these provisions and all those things. See, we actually put it this way. As far as your examination goes, it is pretty good if you actually remember the sections, but your primary importance should be to remember the provisions. So only then the section, everything comes into the picture. So first remember the provision as such. And probably the section automatically will get linked to your memory. So whenever, as I told you, you can have some code words like 80D is for disease. So you'd say it is related to medical insurance. 80C is for contribution. So you can say that for any contribution, it falls under 80C. 80EE is for housing. 80E is for education loan, right? So E stands for education. EEB, you can keep it as electrical vehicle, so it stands for E. So probably my point is, it could be any kind of linking. It might be even a stupid way that you are linking also, it doesn't matter. But if you're able to link a particular word or a concept to the section, you remember the section better. So you'll have to try to link the sections, and probably there will be an order. As I told you, 80EE is for housing loan distributed in 1617. The next section, EEA, the immediate next section, EEA, is for loan distributed between 1st April 2019 to 31st March 2022. So see, there is a pattern. There is a pattern in naming the section. They are not just naming as and when they want. So there is some pattern. The entire 80E, so we were talking about 80E, right? Remember this word E, okay? E, EE, EEA, you have EEB. All of this is for interest, correct? So the reason why this section is there for interest. E is for what? Education. E is for house property. EEA is also house property. This is for electric vehicle. So see the pattern. All 80E is for interest related. So don't get confused. All D, 80D, okay, is all disease. So this is medical insurance, disabled. This is a specific disease. So all this 80D is related to medical. We can keep it disease. So all this 80D has a pattern. You have D, DD, DDB. It's a pattern. So see the pattern in the section names. So that will help you remember the section numbers better. Not just for deduction. Everywhere there will be a pattern. As an auditor, we'll probably be able to find this pattern to remember the sections. Correlate and link the section with the word or a key term so that you will remember the section. So this will be my suggestion for remembering the word. So identify a key term, link it with them, identify a pattern. So with these two things, probably you'll remember the section better. So that will be my suggestion for remembering the section numbers. Okay. So now we'll move on to the MCQs. So that's what is there. There will be the last probably 5-10 minutes, and I'll wind up there. So it's typically the first question, the MCQ's first question is, which of these sections is not covered within the limit specified in 80CCE? So what will be the answer? We saw a formula, right? 80CCE was equal to 80C. 80CCE is equal to 80C plus 80CCC plus 80CCD what? 80CCD what? Only 1. So 2 is not covered. Both 1B and 2 is not covered under 80CCE. So the answer will be 80CCD. So the answer is 80CCD. The next question. Mr. A purchases house property for the first time in 1st April 2018. The stamp duty value. So it is on 1st April 2018. Stamp duty value is 43 lakhs. Loan amount is 40 lakhs. SBI charges 11%. The maximum deduction is available is. So we said section 24 provides 2 lakhs, correct? For additional deduction, 80EE, 80EEA. E says loan must be obtained between 1st April 2016 to 31/3/17. EE says 1st April 2019 to 31/3/22. The date 1st April 2018 is between this. So which means there is no benefit of 80EE or EEA. Both are not eligible for loan obtained in financial year 18-19. So the loan is not available. So what will be the deduction? The only deduction is your 2 lakhs being your deduction under section 24. So that is the second question. Third question, Mr. R obtains a life insurance policy for a child. So is it allowed? Yes, allowed, right? Child is suffering from cerebral palsy. So when you say cerebral palsy, it's mental disability. So what section? 80 DD. The sum assured is 4 lakhs and annual premium on the policy is 55,000. How much is eligible for deduction under section 80C? If you actually see, we had two categories under 80C. We had two categories under 80C. What category we said? For any policies taken recently, covered under 80U or 80DDB is 15%. For others, it is 10%. So here, annual premium of 55,000 for sum assured of 4 lakhs. So the sum assured of 4 lakhs into what percentage it is. So whatever is eligible is basically, it is other case. That is, this falls under 80DD, not DDB or U. So for 80DD, the limit is only 10%. So the premium allowed is 40,000. So that's covered in this question. The next question, Mr. C has been investing under National Pension Scheme. National Pension Scheme, that is NPS. He is claiming deduction under 80CCD. Over the years, he has contributed 5 lakhs till 31st March 2020. Till 31st March 2020, he has been contributing. During the year previous year 2021, he withdrew 1.5 lakhs. So what will be the treatment? So we said as far as the treatment goes, how much? Out of 5 lakhs, he can maximum withdraw 25%. That is 1,25,000. But how much has he withdrawn? He has withdrawn 1.5 lakhs. So the difference between 1.5 minus 1.25, that is 25,000, is what will be taxable under this section. That is 80CCD. 80. Next question is 5. So as far as fifth question is basically central government employee deposits 1 lakh under National Pension Scheme, out of which 25 is towards Tier 1 and balance is towards Tier 2 on additional account referred under 23 of them. So there is Tier 1, Tier 2. We said what? Tier 1 is 80CCD. Tier 2 is 80C. So here on Tier 1, 25,000. So this 25,000 will be deductible under 85CCD. The balance will be deductible under 80C. 75,000 under 80C, provided he has a limit in that 1.5 lakhs. So that's all the questions from my end for today's session. So thank you all. I'll just see if there are a few just questions. Yeah, I'll just answer one question alone. It is about important chapters. I was speaking about remembering the provisions. So as far as the important chapter goes, salary and house property is the most important chapter for you. And individual computation, individual tax computation as a whole, which will have your chapter 6A and everything will be there. So the most important chapter will be salary, house property, and individual tax computation will be primary questions. So with that, probably I wind up the session. So thank you all for the wonderful session. Yeah, over. Thank you.